welcome to the Mortgage Minute for this week, and we're in November. November actually happens to be Financial Literacy Month. It's interesting, an article by Rob Carrick in the Globe Mail talking about beware of the baffle gab. That's his way of saying that the banks are using language. It's ironic. He's basically suggesting that the irony here is that in the month that's called financial literacy, the banks use language that is anything but and confuses the general public. Speaking of which, I'm looking at an article from a couple of weeks ago, and some of you may have heard about the U.S. cutting back on the quantitative easing. There is a term that confuses most people. A lot of people might banter it about like they know what they're talking about, but you can go to a cocktail party and impress your friends by saying, oh, I see that Janet Yellen has pulled back on the QE3 and the U.S. Fed is no longer going to be artificially supporting the economy. Well, that's exactly what happened, but I suggest that I would probably argue that some people are still confused as to what all this means. So what I want to do is take a look at this specifically this week and say, what is this whole cutting back and getting rid of the QE3 or quantitative easing? What does it mean to you as a home buyer? If you're getting a mortgage this week, if you're wondering whether or not you should be taking fixed or variable, if you're renewing your mortgage, what should you be looking at? Well, the quantitative easing in simple terms is printing money. That's where the government, the U.S. government, was basically buying bonds and such and artificially supporting and inflating the economy to the tune of trillions of dollars, as former Fed Chair Ben Bernanke was commenting on. And the bottom line is now the government, the U.S. government, is trillions of dollars in debt and basically saying, hey, economy, you got to stand on your own right now. We're no longer going to artificially bolster you up and support you. So the good news is, the reason they can do that is there's been a recovery and there's strength in the U.S. economy. The problem is, just like if you are artificially supporting someone to get up on their feet and you say, okay, good, you're now standing on your own, I'm going to let go, then that person might teeter and fall back. And that's what's going to happen to the U.S. economy. As such, the Canadian economy will be slightly impacted as well. So it's going to take a year or two, in my opinion, before that U.S. economy can fully stand on its own without any support from quantitative easing or the printing of money from the U.S. government, which they say they're no longer going to do. So we'll see how long they can support that. And in the meantime, Stephen Politz makes a comment that the Canadian economy growth is at risk if low oil prices persist. I mean, we're an export-dependent country, and Alberta is strongly dependent on the price of oil. So that's something, again, we're going to continue to watch. And when you look at that, it's interesting. Last week we saw a headline here saying that the Fed and the Bank of Canada to weigh in on inflation readings. There's indications that inflation is creeping up. So when you see inflation creeping up, the Bank of Canada typically would raise rates. But Stephen Politz is making a comment here saying, given the fact that it's inflation, he sees it short-lived, it's not enough for the bank to consider rising rates. Why? Because he's worried about the fact the U.S. is pulling back from the quantitative easing. So that's how, when you hear this term quantitative easing, the U.S. government cutting back, all this translates to continued low interest rates for you. So if you're in a position where you're wondering, should I go fixed or should I go variable? I can virtually tell you, I feel very confident that the Bank of Canada is not going to touch rates for another year, given the fact of what the U.S. has done by taking and pulling away the quantitative easing and no longer printing money to artificially support the U.S. economy. It's going to result in a longer, extended term of low interest rates here in Canada. So again, what should you do? As always, it's case by case. Your numbers, your personal situation is unique. So give us a call, book a consultation. We will review your numbers, and we'll try to break it down in very simple language so you can understand, because, hey, after all, it is Financial Literacy Month. So that's the Mortgage Minute for this week, folks. Have an awesome week. We'll talk to you soon.